The second type of investment that we have, the second safest, are money market instruments. Financial markets are generally divided into two types. The first one is the capital market. And the capital market is the market where you get stocks, trade stocks, and you trade bonds, basically long-term bonds. Stocks and bonds and long-term bonds are known to be long-term investments, usually for more than 1 year. The second market that you need to know about is called the money market. The money market is for investments which are less than 1 year. If you want to invest for less than 1 year, the money market might be the place to go. What do we have in the money market? We have deposits and we have bonds. However, not long-term bonds, short-term bonds. Now we are going to study the money market. The capital market we'll leave it till later. So what is in the money market? In the money market we have treasury bills. Bill is a bond. We call it a bill because it's short-term, less than 1 year. So treasury bill is a bond by the government because the word treasury means government, and it's a short-term investment. It's issued by the government, usually has a maturity of 3 months, and it's traded at a discount. What does that mean? It means that it does not carry any interest. You buy it at 98 and it is redeemed on maturity at 100. You make your $2 profit. In the same way is the commercial paper. Commercial paper is exactly the same thing as a treasury bill. The only thing is it's issued by companies. You see the word commercial. Commercial means corporates. Paper is another name for bill. Bill and paper are the same thing. Some people call it commercial bills. Some people call them commercial papers. So this is also a short-term bond issued by companies, and it's also traded at a discount. That means it does not carry any interest. It doesn't pay any interest. It's sold to you at below 100, and on maturity you get 100. That means you make yourself a $2 profit. The third one is called a CD, Certificate of Deposit. This is issued by banks only. This is the only one that pays interest. So watch out for an exam question here. CDs are the only investment in the money market that pay interest. They are issued by banks and they pay interest. The fourth one is a bill of exchange, which is similar to an invoice. This is issued by companies, and these invoices are traded in the market at a discount. So let's say this invoice is going to pay the holder $100,000 on 31 December. Currently, this invoice is being traded in the market at $98,500. Now, do not think of it as a normal invoice for goods and services. It will confuse you. Bills of exchange are not examined heavily in the exam, but they're just mentioned in the book, so you need to know it. So what is the bill of exchange? It's similar to an invoice. It has usually a nominal value of 100,000, matures at a date, and it's sold in the market below its par value. All of these basically have the same characteristic. They are for short term, less than 1 year. Most of the time they are for 3 months. That's their maturity, that's their life. They are issued at a discount to face value. If their face value is 100, they are issued to us at 98. They are zero coupon, that means there is no interest. They don't pay interest at all. Keep in mind, there is only one exception to this rule, and that exception is the CD, Certificate of Deposit. It's the only investment in the money market that pays interest. And they are all in bearer form. Bearer form, that means no registered name. You know how a check can be made to cash? That means anybody who holds that check can cash it and take the money. Nobody's name is on the check. We call that bearer. Please pay the bearer. So these investments in the money market are all bearer. That means they do not carry our names on them. Bearer is the opposite of registered. We are going to see registered when we talk about stocks. Registered is when you buy a security, your name will be on it. Bearer is the opposite of it. These characteristics of money market is a popular area in the exam. You always get a question on the characteristics and a question on different types of money markets. Money markets are known to be safe, liquid, but they bring low returns because they have low risk. They are usually used as a short-term home for cash. Instead of normal fixed deposits in banks, some clients prefer to invest in the money markets because they give a bit better return. The problem with money markets is that they require high capital and they are therefore not accessible for individuals, otherwise known as retail investors. Instead, individuals can invest in funds that invest in the money markets. We're going to study money market funds on the next page. Yes, Khan, certificate of deposits are also bearer. So, what two options do we have when we invest in the money market? Let me start a new page just to make things clearer for you. Usually when the government issues bond, it issues bonds in an auction. Let's say this government is issuing $5 billion, the US government is issuing $5 billion of treasury bills. It makes an auction and invites the banks to auction for it. Let's say Citibank buys $1 billion worth of treasury bills. Citibank can offer these treasury bills for its clients to invest in. Citibank can offer it to them in one of two ways. The first way Citibank can offer it to them is through what we call a money market account, known as an MM account. What is a money market account? It's a savings account. And its returns linked to money market, to the treasury bills. Whatever return Citibank is getting from these treasury bills, they will give us in this savings account. The problem with this money market account is it requires high capital. So you're talking about $50,000, $100,000 and above. The good thing about this is, as a savings account, a money market account has central bank protection. That means if Citibank collapses, my deposit is protected by the central bank. So what if I don't have high capital? What is my other option as a retail investor? Well, Citibank can offer me another option, and that is a money market fund. It's a mutual fund, sort of a mutual fund. It's a mutual fund that invests in the money market. So what is a mutual fund? Mutual fund is a collective means group, collective investment. That means a group of people will invest in it. You can buy shares for minimum capital. That means for a small amount of capital you can buy shares. And you are considered a shareholder if you invest in a money market fund. You are not considered a depositor. And because you are not considered a depositor, a money market fund is not protected by the central bank. So as you can see, money market account and money market funds, both of the returns are linked to the treasury bills that the Citibank has bought. Both are offered to investors. One of them is a savings account, the other one is a fund. One of them, if you invest in it, you are a depositor. The other one, if you invest in it, you are a shareholder. One of them requires high capital, the other one requires minimum capital. And one of them, which is the money market account, has central bank protection, whereas money market funds does not have central bank protection. The difference between money market account and money market funds has one question in the exam. And this is what this page is telling you about. This page is giving you the difference between money market accounts and money market funds.